Rates are on hold, inflation's picking up, rents are still squeezing tenants. If you're feeling that something doesn't quite add up, you're not alone. So today I want to ask Australia's leading housing economist, Dr. Andrew Wilson, about two things that matter enormously to every property investor and homeowners in Australia. Things that are happening right now. Firstly, why the Reserve Bank again left interest rates on hold at 3.6%. And then also what My Housing Market's latest October 2025 rent report is really telling us about what's happening in the rental crisis. So welcome to this week's Property Insider, where Australia's leading housing economist, Dr. Andrew Wilson, and I take you behind the headlines to uncover what's really going on in Australia's property markets. Each week we like to share the data, the trends, the insights the mainstream media often misses. That's going to help you make smarter, more confident investment decisions based on facts, not on fear. So Andrew, we've got a couple of interesting things to talk about today.
Yes, we've had another. In fact, it's a big focus, the Reserve Bank's November meeting, Michael. Traditionally, we do see some movement, of course, depending on the cycle, the economic cycle, on November, which of course is also Melbourne Cup Day. The reason behind that, I think, is because it's the last month where, for the year, that an interest rate change, either up or down, can make a difference. Because once we get into December, and there will be a December meeting, we're really a distracted economy then from December onwards until February. So we don't really see the sort of impact an interest rate change could have because we are in holiday mode. So November becomes important because it can still influence the economy through to the end of the year. So a lot of focus on the November result. I think that you and I were both quite clear that it would be a stable result. Was again talking about, sort of headline grabbing. I noticed there were a few that were predicting an interest rate increase, Michael, at the November meeting. And I had some interesting conversations around those predictions. I don't want to use the word clickbait, but, it does smell. If it smells like clickbait, perhaps it is clickbait. But I'm not sure we were anywhere near an interest rate increase. And I'm not sure we will get an interest rate increase anytime soon, Michael, because given what's happening with inflation, which is being driven by higher electricity prices, which were eminently predictable. And again, we've discussed this over recent months that, what happens when the government changes its electricity subsidy to electricity prices, and therefore what happens to inflation, and therefore what is the outlook for interest rates as a result of that. And we knew that we were going to get a surge in electricity costs once the government's subsidy ended. And of course, we've still got a subsidy, but it's what I guess you'd call subsidy light until the end of this year. It's only half of the support we had last year. And state governments have also changed their subsidies as well. So next year will be very interesting, Michael, because we won't have the subsidies. Of course, there is a disclaimer here, Michael. Perhaps the government will sniff the wind to some degree and give us another subsidy, but we wait and see that, because I think that's the only thing that's going to stop a continuing sharp increase in electricity prices and a sharp increase in inflation as a result, all other factors notwithstanding. And therefore, there will be more talk about interest rate increases because of higher inflation. But, how is an interest rate increase going to push down the price of electricity? It's just nonsense. All it will do is exacerbate what is a weakening business cycle at the moment. Our economy is still strong, but, it's called a cycle for a reason, the business cycle, and it's just starting to ease. And higher interest rates would be the last thing we'd need at the moment. And in fact, it would be against what we're seeing in other advanced economies, which, if we look at the America, Michael, they're cutting interest rates because of concern over their labour market, their business cycle. So it's a vexed position, but I'm not sure about this, the Reserve Bank's we're so surprised scenario. I mean, I'm a little confounded if they are surprised, because we always knew we would get higher inflation once the electricity subsidy eased. And we've known that for some months now, Michael.
Really, the Reserve Bank's trying to find an interest rate that doesn't stimulate the economy too much, pushing up inflation, but restrict it too much to, dampen demand too much. It's got to find that Goldilocks race. No one really knows exactly what it is. I think most economists thought it'd be a couple of interest rate drops further than it has happened now. But now there's talk of interest rates not changing until maybe the middle of next year. And others, as you're suggesting, are saying there may not even be another drop at all. It may go up. But by pushing up interest rates, that's only going to dampen our economy and make things harder for the average consumer.
Well, that's right, Michael. But I think the question is, why did we cut interest rates in the first place? We had inflation falling because of the fall in the international price of oil and the fall in the price of electricity locally because of a subsidy from the government. It wasn't because our underlying inflation had consistently met the midpoint of the Reserve Bank's target range. Without those two factors, it never would have happened. But we've had 3 consecutive interest rate cuts, well, on the quarterly basis this year, February, May, and then in October. And this, of course, has been great news for homeowners because it's put a rocket under house prices. Because why would be surprised? In a still strong economy, lower interest rates, the economy's been strong. We've had 3% something unemployment rates for the best part of 2 years. Yeah, a little higher now, but this is still you could regard as a full employment economy with interest rate cuts. And as I said, it's not based on prices growth, overarching prices growth. It's 2 main factors that have been pushing up inflation. So I don't see where the outcome, a change in interest rate, has got anything to do with the macro economy. I think we've got at least 1 interest rate cut too many this year. But so what? Good news for homeowners and good news for the economy because it will continue to put a floor under a weakening business cycle. But, I'm just a little bemused at some of the comments that are coming out of the Reserve Bank now about, oh, gee whiz, we didn't realise this was going to happen sort of thing, that inflation was going to rise. I mean, they need to look at the specifics of inflation rather than, textbook overriding macroeconomic policy and guiding their monetary policy along those lines because the last jurisdiction of the Reserve Bank didn't have a good record. We've got a completely changed environment with this Reserve Bank. And I'm not sure we've come off, especially this year, come up, to a good start in terms of trying to provide a bit more, clarity or reliability with the decisions that the Reserve Bank are making. I wouldn't be surprised, Michael, if we saw perhaps the government under pressure to provide another subsidy for electricity. That's the only offset I can see for higher inflation. And as you said, if we do get inflation surging because of higher electricity prices, which I think without a subsidy is going to happen, then we're going to get more calls for interest rate increases, which is just nonsensical because how's that going to affect the electricity prices? But, going forward, we are going to experience 2025 as a very strong year for the housing market. That's going to make many households feel a lot more comfortable about their position in terms of increased wealth. And we're also, we're happy about those lower repayments that we have now, particularly given that we have had a surge in inflation in the post-COVID period, last 3 or 4 years. That's some relief, at least through lower interest rates. But it's going to be a very interesting year next year, Michael, and an interesting December meeting, I think, also from the Reserve Bank.
I think homeowners and investors shouldn't count on an interest rate fall anytime soon. The Reserve Bank says inflation is only going to drift down to the middle of their 2 to 3% band over the next couple of years, possibly even. So
That's changed.
Well, we keep saying, though, that there's other fundamentals that are driving our housing markets. So don't worry about the interest rates. If you've got the finance ready, if you need to move home, if you need to invest, just take into account what the current rates are and make a move. And this is possibly a slight window of opportunity when others are going to sit on the sidelines. But the first home buyers are out there, as we've discussed. Investors are back in the market and people are just getting on with their lives, but the media is holding them back. Unfortunately, though, it's not as good a market for tenants. The latest My Housing Rental report came out, the October rental report, which will be in the blog attached to this video. And you report that vacancy rates fell in most cities and tenants are still having a hard time.
Well, we usually see October as a month where the midwinter easing of demand reverses, and we've seen that as usual this year, Michael. Higher demand for rental properties has seen an across-the-board fall in vacancy rates, which are now back, and really they haven't changed much over the past few years, are now back at around record low levels. And as I said, almost across the board. We're not seeing the growth yet in rentals, in rent, that we would expect from low vacancy rates. I think there's some affordability issues there that are still keeping rental growth reasonably subdued. But I wouldn't hold your breath with these low vacancy rates, Michael. Sooner rather than later, we will see higher rents. There's still plenty of competition. You go to just about any open for inspection for a vacant rental property at the moment, and there'll be queues of people applying for that property, and that's what these vacancy rates reflect. And as I said, I think as we continue with low vacancy rates, and as I said, October was a tightening of the rental markets in terms of vacancy rates. We'll eventually start to see higher rents. In fact, the ABS reported, Michael, over the September quarter inflation data, that rents were actually starting to rise after a period of falling rents. They're now reporting higher rents overall. And of course, we're just reporting asking rents here. The ABS report on rents, not just asking rents, but also rents with leases involved. So let's have a look at the data. Reasonably flat in terms of house rents over the month. Most capital cities reported flat for rental changes over October compared to September. The big mover was Darwin, up by 2%. Very strong housing market at the moment, Darwin, Michael, after a lengthy period of subdued activity, both for rents and for prices. Adelaide down slightly by 0.4%, Hobart down by 0.6%. Over the year, Sydney's been flat, Melbourne down 3.3%, but all the other capital cities have reported solid growth over the past year for house rents. But when we look at the vacancy rates are either just above 1% or below 1%. In fact, most are below 1%, and some are near record low levels. The top vacancy rates were Canberra.
It's quite an anomaly, isn't it, with vacancy rates so low that rents have remained flat over the month?
I think it's affordability, Michael. I think that this is what we've seen for the past year, that you get to the point where, tenants just can't keep paying, an extra 10% for rents, because we've seen a subdued incomes growth. But eventually, of course, the capacity to pay more is improved, particularly in a strong economy. And I think, even though demand increased, we've seen a lot of first home buyers move into the market as buyers, obviously, over October with that with the first home buyer scheme that the government's introduced. But I don't think it'll be long before we see higher rents. And I think, landlords perhaps are now looking at quality rather than price. They're looking to secure a longer term tenant, perhaps, rather than one who can pay a little bit more in rent. But as I said, over time, as incomes improve, I think that we will see higher rents. But you're right, it's counterintuitive to some degree to see these very low interest rates and tightening over October and not seeing rental increases. But this has been a trend for the past year. But we've got to understand also, this followed a couple of years of extraordinary rental growth following the end of lockdowns and the opening of our borders and the surge in migration. And of course, we're not seeing the same surge in migration because the migration numbers have been cut. But nonetheless, we're still seeing strong demand driving low vacancy rates. And I think sooner rather than later, we will see higher rents as a result of that. And as I said, the ABS is already reporting an increase, a shorter term increase in rents in its latest data. And when we look at units, Michael, similar story. Vacancy rates are sharply lower in most of the capital cities for units over October compared to September. Vacancy rates a little bit higher for units, which is what we typically see when we compare units and houses in terms of vacancy rates. The top capital cities in terms of the highest vacancy rates are Melbourne 2% and Canberra 2%. But they've had a significant tightening even at the top range of the vacancy rates, and they're starting to absorb a lot of vacant rentals now. But all the other capitals are either just above 1% or below 1%. So even with those exceptions, Mike, I would say generally we have tight rental market for units as well as houses. And similarly, we don't see, a breakout in rents in terms of the unit market similar to houses. But I think that eventually we will see that eventuate if these vacancy rates remain, which are just extraordinarily low.
It's interesting that at Metropole, where we manage a lot of investors' properties, they expect the rents to go up each year when the rent review comes up. But I know when our team are now telling them, hey, your lease has expired and this is our recommendation, and we actually can't put up the rent. It's really much the same as a year ago, the market rent. Your statistics are confirming that also. So it's a little bit disappointing because many landlords have just hoped it kept going on. It can't keep doing that. But Over the long term, it will. It's just the ups and downs of the cycle.
Yes, Michael, but I think landlords would be happy with their capital growth over the past year. So it's swings and roundabouts, perhaps, and you just point out it saying, well, your capital growth has been tremendous this year, and just you haven't had perhaps, by and large, generally, but you haven't had the rental growth. But look at what your rents were 2 or 3 years ago, and look at what your yields were 2 or 3 years ago. And yes, guess what? Your yields are falling, but they're falling in the best environment because of strong capital growth is pushing down the return. And I think if you scratch any landlord, Michael, what they'll really be looking for is capital growth rather than those returns on investment. It does differ, of course, but I think that makes a landlord most happy is capital growth.
Well, smart.
So anyway,
We've been around the cycle a few times and seen is periods of strong capital growth, periods of strong rental growth.
yes,
Rare that the
Yeah.
two go together.
that's right. And that's the change in yields that you do get. But, it's if there's lack of activity, but there's plenty of activity in markets, either from tenants seeking properties or from buyers seeking properties to buy. We get the latest loan data out next week, Michael, from the ABS home loan data. It'll be interesting to see then. It's a quarterly data set now, not monthly, unfortunately, but we will be able to see just how active investors have been over the 3 months to September. And I wouldn't be surprised if we saw another rise in investor activity, given just how strong or the lure of higher prices that it draws investors into the market.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, that's what we're seeing on the ground on the weekends when the auctions come, and also the private sales where investors are back in the market. It was a weekend without the distractions of the last couple of weeks now. There's just a few good weeks going in the auction before we start to get too distracted again. How did the auction results pan out last weekend?
Well, we're now moving into the peak season, Michael. As we wind down, we've got 6 weeks left until the holiday break, which runs through till early February. This is when we do see large numbers of properties in the market. And typically we see lower clearance rates, Michael, which is relative to what's happening in the cycle. Even if we are in a strong cycle such as we've had this year, we're still seeing lower clearance rates. But the point is that we're seeing a surge in the number of properties being put under the hammer every week in all our capital city markets, Michael. But what that means is, yes, we're seeing perhaps just a slight decline in vacancy rates, but overall sales are booming. A number of properties being sold, because when we look at the number of properties coming into the market and the number of properties being sold at the rate they're being sold at, that's actually rising. The number of properties that are being sold at the moment is accelerating. Plenty of appetite there. And this is what we see as the market peters out. And this, as I said, this is now the part of the market where people want to get it all done by the end of the year. And with the higher numbers of properties, even though we're getting higher numbers of actual sales, it is about more competition amongst sellers because there are more properties and more choices for buyers, but still very strong results. We'll have a look at the past week. And as you said, the distractions have gone. We had Melbourne Cup the previous week. We've had the football finals. We've had various public holidays. And all that meant is that we had a sort of a pause one week and then a catch up the following week, or the anticipation of a pause the following week and a large bringing forward of activity for that week. So we're past that now. So we have now a clear run into the end of the year, Michael. So let's have a look at the results from the last week. Big number of auctions again in Sydney, 1,534 auctions. Another very positive clearance rate there. Certainly a seller's market in Sydney continuing a little bit down, just marginally down 0.5% compared to the previous week. But as I said, nearly 100 more auctions, so more sales being conducted. But with all our capital city markets, when we look back to the same week last year, we can see an improvement, and not just in the number of properties being auctioned, but also higher clearance rates. A year ago, Sydney had a 67.6% clearance rate and is tracking about 100 more auctions for that same week. Melbourne bounced back after its Melbourne Cup long weekend holiday. 1,345 auctions in Melbourne, still above 70%. Melbourne, 70.5% clearance rate, which again is significantly higher than the same week last year, Michael, with similar auction numbers. Another big week of auctions in Brisbane, Michael, 200 plus auctions in Brisbane, similar to the week before. Clearance rate just under 50%. We know Brisbane has its own model of auction activity, so we always look at anything around 50% or higher as being a positive market in Brisbane. And again, well ahead of the same week last year, which had a clearance rate of 34%. Adelaide, fewer auctions after a big week the previous week. Back to 80% in Adelaide. Strong result for Adelaide. We got used to seeing 80% clearance rates in Adelaide consistently, but back up to that over the past week. And Canberra now is certainly tracking in that terrain that we'd call a seller's market in the mid-60s. And we can see there across the board that every clearance rate, all our capital city clearance rates are well above the same period last year, Michael. And when we look at the monthly charts, we can start to see that pattern emerging, that end of year pattern emerging, with a slight decline over November so far compared to October. And most markets were a little bit lower in October compared to September. But that's the pattern that we see every year, Michael. But we wouldn't be complaining about the levels of clearance rates if you're a seller. This is still very much a seller's market in all capital cities, even those that were sort of underperforming, such as Melbourne and Canberra a year ago, are now clearly in favour of sellers. And if I just might add to the Melbourne market, very interesting, bit of still a dual speed market in Melbourne, Michael. And it's really the inner east, which has actually been the underperformer, certainly for the past month. It's been recording the lowest clearance rates of any of the regions. Most of the other regions all of them are quite positive, but it's just interesting that inner east Melbourne market is the part of the market that continues to drag the chain. And of course, that's noted as being, if not the highest or the most prestige market, Melbourne real estate market, one of the prestige markets. But it's just been really, at best, tracking sideways, even through the spring selling season, which is usually the time when eastern suburban Melburnians are out there buying and selling, the inner eastern suburban Melburnians. But just hasn't happened this year, Michael. So that's what's, I guess, holding that Melbourne market back from being even stronger, its revival being even stronger than what it has been.
Well, I guess what you're saying is there are markets within markets, and certain segments are doing very well.
It's very interesting to speculate on why. Sorry.
Yeah, no, I agree with you. On the other hand, the median range properties and the lower price properties are still performing very strongly, not just in the auctions, but in private sales as well, where investors, first home buyers and upgraders are still moving. I guess we've entered this unusual phase. The Reserve Bank's cut interest rates 3 times, but still not enough for some borrowers, many borrowers, to feel real relief. Inflation's it's peaked, but it's still too high for the Reserve Bank. Rental markets are tight and rents are going to keep going up. So I think this is the time where it's important to keep getting good information, but also calm thinking, not be caught up in the media. And that's what I know you bring to us each week in these Property Insider chats. So I look forward to catching up with you again next week when you bring some clarity to all this confusion.
Thanks, Michael. And just on the prestige market in Melbourne, you say markets within markets. It's actually not sort of across the board prestige in Melbourne, because the inner south's been doing quite well. It's the inner east for some reason. It's I guess that which we sort of regard as the conservative prestige market just hasn't been finding buyers or sellers, as we would expect with a revival, lower interest rates, perhaps more confidence, but just hasn't worked its way into that part of the market. And yet other prestige markets, such as the inner south, are doing okay. Interesting. That's why we're here to clarify.
Good. And speak to you again next week. Thanks.
Thanks, Michael.